A warm welcome to Market Pulse by SC Securities and Daily FT. As usual, our effort is to give you a better pulse about the equity markets of Sri Lanka. Sri Lanka is going through some challenging time as we speak. Unprecedented challenges required collective solutions. Today's program is very special. There are 7 stockbrokering company research heads coming on one stage to share their insights with you. I'm Dilusha Gamage from SC Securities, and my co-host is Nisthar Cassim, the editor of Daily FT. And let me welcome the panelists. From my right-hand side, Hasitha Leanage, the head of research, Capital Trust. Mahesh Udugampala, head of research, SoftLogic Stockbrokers. Charitha Gunasekere, head of research, SC Securities. Dimantha Mathew, head of research, First Capital. And from my left hand, Nusrath Mohideen, manager research, Bartlett. Naveed Majeed, senior vice president research, Asia Securities. Shehan Cooray, director, head of research, Equity Stockbrokers. Saliya Gamagedara, manager sales, SC Securities. With that introduction, let me hand over controls to my co-host, Nisthar.
Thank you very much, Dilusha. After a 2-week recess, which had been controversial as well, market will open in the next 1 hour. And today, this panel, eminent panel, will try to sort of guide us as how, in their perspective, how should investors look at the market going forward. And I'm sure we will have some very frank exchange of views. And I will invite everyone, each of the head of research to share their perspective and also say, give reasons to, in terms of whether it's a buy, sell, or a hold decision in a broader perspective. So I start with Hasitha in terms of giving the perspective from the Capital Trust research.
Thank you, sir, and thanks, Dilusha, for the invitation. So let me start off with the current reason for the market jitters. Today is the first trading day after the policy meeting on the 8th of April, if I'm not mistaken. So today we'll see investors digesting the increase, the unprecedented 700 basis points increase in policy rates. So let's just go back a step to see exactly what really happened. So with the 67% depreciation after the floating of the rupee on the 7th of March, obviously price of essentials have skyrocketed, price of medicine has skyrocketed, fuel has gone up. Soon we'll see price of electricity going up as well, and various other basic essentials have gone up. As a result, inflation has really gone through the roof. For example, I think in March, CCPI was at 18.7%. NCPI was recently announced at 21.5%. And in April, we could see this even going up further with the recent fuel price increases. So yes, I think the new governor had no option but to increase policy rates. But when we are looking at nominal policy rates, I think the T-bills are now at 24.36% as of the 20th of April, the recent auction. We need to take a view as to where these rates are heading. So in the medium term, I think the central bank has made a call. If you look at the last auction, they only accepted bids below 25%. So I think they're of the view that the rates have overshot to a certain extent. So until inflation goes higher, we might see rates at these sort of levels. And with the exchange rate stability coming into play, we might, in the near future, see even rates coming down if we control inflation to a certain extent and central bank is successful. So in that aspect, we need to really look at just not the nominal interest rates, right? So if you look at the face value of 24% or 24.36%, net of taxes, I think it comes down to around 20%. So if you look at the two indicators, if you look at NCPI, then you're looking at negative real interest on that side. But if you look at CCPI, then you're looking at positive interest. So I think central bank has taken a view that they'll maintain near zero real interest going forward. And even the last week's auction, I think on the lending side, they rejected all bids, which gave an indication in the interest rate market that they don't want interest rates going up in the short term. So I think the market needs to digest that on the interest rate to see what's really happening. So from a investor's perspective, you need to, I'm sure they would require asset classes that provides returns more than 0% real returns. So then what are the options available? And one of the asset classes is equities. So if you look at what has really happened to equities with all this market, with the economic turmoil, from the peak on the January 19th, I think the market has come down around 39 to 40%. In USD terms, it has come down about 67%, if I'm not mistaken. So the market Ps are now, I think, at 8.05, which is again a 40% reduction from the 15 Ps that we saw in January. So has the market really overreacted to some extent with this economic turmoil and various social unrest is a question that we need to ask. I think with the various IMF reforms coming in as well, there will be increasing fiscal, increase in tax rates going forward. There'll be certain other reforms, SOE reforms that will increase electricity tariffs, for example. These will all have knock-on effects on cost of production, etc. So when you're looking at the equities, yes, we need to look at select equities that will provide you the protection against these. There are certain dollar income shares that obviously their revenue has increased. Net profits also will increase accordingly with the 67% depreciation. Then in terms of increase in taxation, there are companies that have deferred tax assets, large deferred tax assets, large carried forward tax losses that will provide certain protection against increase in taxes as well. So you need to look at growth counters that have these sort of inbuilt protections in place that will provide investors protection against high inflation, high depreciation, and increase in taxes. So in that perspective, there are certain counters that are trading at 3 to 5 PE in terms of forward earnings. That will probably give that sort of protection. And in the medium term, there should be a move from fixed income to equities. But in the short term, obviously, the market volatility, we can't really predict because from forced selling to whatnot, there will be some volatility in the short term. And there'll be investors who wait to see the bottom and then take certain positions and get that protection against depreciation and inflation. So those are my views on that topic and where we will head.
Mahesh Udugampala from SoftLogic Stockbrokers.
So basically, there has been a lot of uncertainty around the economy and the markets over the last couple of months. And to curtail inflation and to have more stability, we have seen the policy rates being increased by 700 basis points. And right now, the question is whether what sort of investment strategy that investors need to look at. So in terms of interest rates, fixed income is giving you decent returns, yes, but one would argue that inflation is so high and much higher than the returns that are offered by fixed income securities. Yes, I think as Hasitha correctly mentioned, there is negative real interest rates as of now. My view is kind of a bit different from that point. Yes, in the first year, if we can lock in at higher rates for the next 3 or 5 years, yes, in the first year we would see some real negative interest rates. However, if you start from the second year onwards, as we're expecting improvement in the economy with all these reforms coming in and with the IMF coming in, we would see inflation dying off, and we would see from the second year onwards, we would see positive real interest rates. So we can't rule out that fixed income securities are offering a good or a decent return. But on the other hand, if you are an investor who wants a higher return, and if your risk appetite is much higher, what you would probably want to see is better returns. So equity is the other option that you would be able to do that. But saying that, I would say one shouldn't invest in the short run for short-term gains, let's say for 3 months or so. But what I would think is, if you are investing in equity, it should be more of you should have a more of a longer-term view. And why I'm saying this is basically right now, in order for us to see a major improvement in the economy or in the economic indicators, it will take some time, because right now the government is looking at restructuring its debt, and they need to do certain reforms. They need to implement those reforms in order to meet the requirements of the IMF. So it might take some time. So probably if you are investing in equity, probably you need to look at a more longer term view. And in terms of investing, I would say, rather than because there is so much uncertainty, you need to look at certain sectors that can outperform in this kind of a market. So the strategy should be to look into sectors that can do well in this in a crisis like this. So certain sectors like export counters, and also sectors that are exposed to tourism and real estate would be good investments as of now. And also what we have seen in the examples of other countries which has gone through similar crisis is that after a certain period, when we see an improvement in the economy, we would see markets performing extremely well. And there are certain counters despite the crisis. One other sector that I would like to mention is commodities, because there is there is high inflation in the economy, and commodities would give you a better hedge compared to some of the other investments in these kind of scenarios. So that's my view on the economy and the market.
Thank you very much. I move on to Charitha Gunasekere from SC Securities.
Right. Thanks, Nisthar. Thanks, Dilusha. So both the previous speakers, Hasitha and Mahesh, mentioned about the macro conditions. As they mentioned, the interest rates are giving negative real returns. NCPI is around 22%, CCPI is around 18%, whereas the treasury bill rates around 24%. So even if the NCPI against the interest rates are giving a marginal return, that is quite small. If you look at the leading banks are offering around 13% return on fixed deposits. So what is the alternative investment opportunities that are available for investors is a big question. So what we feel as analysts is that yes, the market has come down. Market has come down over the last 3 months significantly. And if you look at the share prices, most of the fundamentally strong shares, the prices have collapsed in the ranges of 50 to 60%. And if you look at their price earning multiples, there's quite a number of shares that are trading at multiples around 3 to 4 times and price to book value less than 1. So what investors should ideally do is they should look at these counters case by case, right? They should not be misled by the herd instinct. They should look at these counters, look at their future earnings potential, look at the future value, right, and make their investment calls. One other thing that was mentioned is that foreign investors, you see that since the rupee was floated since 8th of March, we saw foreign investments coming into selected fundamentally good shares, right? For example, I'm just taking one company, John Keel's, we saw foreign investment coming. So that's a good sign. Then in terms of the current foreign reserves are concerned, yes, the foreign reserves are low and the government is in negotiation with the IMF. And if IMF comes up with a loan package for Sri Lanka, that would be an acknowledgement of the reforms the country is taking in. So already monetary policy reforms have been taken. The policy rates jumped up by 700 basis points. And you will soon see that fiscal reforms will also take place. So that would put the country in the correct direction, and that would enable foreign funding agencies to look at Sri Lanka. So when that happens, people will gain confidence, especially after the IMF loan being granted to the country at a future date. So that would give the necessary confidence and the impetus for foreign investors to come and invest. So I think it's an opportune time for investors to collect fundamentally good shares. As both the previous speakers mentioned, I think export-oriented companies are kind of insulated against what we are seeing in the market, right? There are certain companies where like 90% of their revenue is coming in the form of foreign exchange. And there are quite a few other companies who are generating like 50 to 60% of their revenue in terms of foreign exchange. So those companies are the ones investors should look at right now, and they have actually come down in value. For example, I'll quote another company, Haley's Group. You see that their price earning ratios have come down. So this is another company which is doing quite well. So what investors should do when the market opens up today is cautiously look at their portfolio and see, okay, these are my shares. What are the ones which can outperform portfolios to hold on to these good shares?
Thank you very much. Charitha, I move on to Dimantha Mathew, Head of Research at First Capital.
Thank you, Nisthar. So basically, looking at the current macro environment, this kind of economic shock is something that we've been expecting for a while. So it's basically nothing new in terms of First Capital's perspective. So from 2018 onwards, we've been going on a deteriorating path. That's why we've been mostly conservative on our recommendations. So tax cuts in 2019 has been the biggest factor that has accelerated this economic shock. So in our perspective, we've actually started becoming positive on the market. So if you look at the last 6 to 8 months, we've been significantly negative on the market, basically recommending to sort of cut portfolios from last August onwards, 65% to 50%, and then as close as March, we were recommended to cut about 90% of the portfolio. So basically, what we were expecting is this kind of a economic shock. So our focus was to preserve the capital of the investors and get them ready for this kind of a shock and this kind of a uptrend in interest rates. So something that we didn't factor in to our worst case scenario is the change in governor, where we've gone on to a more aggressive path of monetary policy and the public unrest that is there in the market. So all these factors are additional factors which are worsening the worst case scenario. So basically from that point onwards, what we are looking going forward is something positive. So if you look at it, 9,000 to 10,000 for the all share price index was our ultimate target for this year, and with the index now coming below this point, basically we are starting to recommend investors to add shares back into the portfolio, but there is no hurry in adding shares into the portfolio because the interest rates are significantly high, and as some of the analysts also mentioned, things are likely to get worse before they get better. So we are expecting negative GDP growth for this year, and with that inflation also is likely to probably worsen. We are expecting somewhere around 26 to 29% of inflation by around June, July, which will basically worsen the current situation, and it may worsen the shortages. So what should you do as investors? We believe that you should be taking advantage of this current situation. There could be a dip in the market, so take advantage of that dip, try and buy into the market. And what do you need to buy into? Specifically risk averse assets is what you need to go into. Even in the stock market you have those kind of assets. Investors could go into things like dollar income companies. So with the heavy depreciation, there is likely to be a huge advantage there. Then you can go into depressed assets like the banking sector counters. Then you have life insurance companies which benefit when interest rates move up. So there are a number of assets that you can actually go into even in this kind of situation. This kind of economic risk is nothing new to Sri Lanka. We've gone through this in 2001, 2008. So with that experience, we know that there is likely to be a bounce back. Beyond June, we are likely to see a IMF program coming in. We are likely to finish off the debt restructuring. So aim at those. With those, there is likely to be uptrend in the market, but obviously it's not going to be an overall uptrend of the whole market. So it could be specific shares that you could be looking at. We saw this even in the downtrend in 2011-12. Basically where we saw high dividend yielding counters significantly increasing value in the downtrend of the market. So that is something that you can expect in the overall market, and that's where you should be going into. So gradually and very slowly accumulate stocks and invest for the next 3 to 4 year time period. Thank you.
Thank you very much, Dimantha. Fairly comprehensive. And we got a fair idea from the right-hand side of the panel. I'll move on to my left-hand side, Nusrath Mohideen from Bartlett Religia Securities.
Yes. Thank you, Nisthar. So I think everybody in this panel has already spoken about IMF and interest rates moving up and inflation, so I'm not going to touch too much on that again. But I think, yeah, like everyone here said, market is opening after 2 weeks. So I think the question most people have right now is, has the market hit rock bottom, or are we going to look at a further decline? It's actually hard to say how it's going to react. So many things have happened within the last 2 weeks. We have seen political instability building. On the other hand, we have seen some changes in the right direction that has taken place. So things can go either way. It really depends on how the investors will look at it. We can't rule out the fact that political instability may play a greater role in investors being, may see a little more panic initially. But then after some time, I think there is a lot of opportunity in the market. So we did see the market give a 74% return last year. And also I have to touch the fact that even during turbulent times, even during the pandemic, companies have come out strongly. They have sought different ways of operating. So I don't see this situation any different. I think this first 2 quarters of this year is going to be very, very challenging because of the inflation rates and interest rates going up, and also world over freight rates going up, and everything having an impact overall, not only for Sri Lanka, for around the world. So having said that, again, I also agree with most of the panelists here that there is a lot of opportunity, especially on dollar-based earning companies. Of course, there's a natural hedge, but then again, we have to remember that there are operational difficulties that most of these companies are going to face. So we are going to see the impact of that within the next 2 quarters. But fundamentally sound stocks are there. I think as a broking community also, we have a role to play. Institutional investors, high net worth investors, they are usually informed investors, I believe. So it's the retail investors that we need to educate, because they are the investors who eventually get their fingers burnt. So it's our responsibility to educate them, and what I would say is speak to your investment brokers, speak to your research units, see what are the sectors that can benefit. At this time, it's actually hard to say which sectors are going to particularly benefit and particularly go the other way around as well. So what I would say is speak to your research units, take informed decisions before you can move into the market. So there are sectors, there are stocks that can have a benefit, but I would say not in the short term. Take a more medium to long-term view is what I would say. Thank you.
Thank you very much, Nusrath. I'll move on to Naveed Majeed, Senior Vice President, Research, Asia Securities.
Thank you very much, Nisthar, and thank you very much for inviting me to this panel. And as Nusrath mentioned, I think most of the other panelists touched on the macro front and the macro indicators, and I'm in agreement with most of what they mentioned. We also see things getting worse before they actually get better. So there is going to be a heightened level of economic uncertainty. There is going to be political uncertainty. So I'm going to keep my comments focused on the market here. So just starting off with how we've seen this market decline and investor sentiments overall, with the level of economic uncertainty and political uncertainty that came about, what we saw investors taking was a risk-off approach. So regardless of where we saw inflation and negative real rates, investors saw more towards capital preservation in a time like this, and that's why we saw some of the money being pulled out of the market. Now, today is going to be the first day of trading ever since the monetary policy review that took place on the 8th of April, where we saw a sharp increase in interest rates. And as you know, equity markets generally have a very immediate reaction to interest rate movements. Now, for us, we've not had the opportunity to give the market to make that adjustment over the last 2 weeks. So naturally, with fixed income becoming a more attractive asset class than what it has been over the last 2 years, realistically, we can expect there to be some amount of weightage in the portfolios being put towards fixed income. So in terms of expectations for the market this week, I think investors should expect this adjustment in the market to come about. But having said that, as any smart investor should do, they should always diversify their portfolios. And with the sort of decline we've seen in the equity markets over the last couple of months, down almost 50%, we've seen certain stocks down 50 to 60%. This provides a very apt entry point for investors to get into and to diversify their portfolios also to equities, and gives a very good opportunity to bottom pick. So how do you look at or how do you approach stock picking in a market like this? And I think, as mentioned by some of the previous analysts, I think one of the obvious or one of the more attractive sectors to be exposed to at this point is going to be the counters that are dollar exposed. And you're going to see their earnings improve purely on the FX growth that's going to come about. Maybe to an extent you might see on the freight side or on the volume side, given global tightening of conditions, you might see some decline on the volume side, but overall with the FX growth, you're probably going to see a growth in their earnings. So I think that's a no-brainer in terms of exposure to USD-based counters. But on the other hand, again, I think one of the challenges investors are going to face in this market is how the level of economic uncertainty is going to feed into equities and the corporate performance. I think Nusrath also mentioned you're going to see, there's going to be an impact on the demand side for companies, coming from an impact from a reduction in real purchasing power. On the supply side also, you're going to see the impact coming from issues such as the dollar shortage, such as energy interruptions. So the extent of this impact is really, it's too early to kind of judge, and over the coming quarters we're probably going to see. So an approach investors can take to looking at stock picking is to look at how resilient some of these companies are, their balance sheet strength and their capabilities of weathering the storm and going through an economic crisis. Another way to look at stock picking in this market is to stress test some of these companies to their absolute bottom fundamental values. By doing this, in a market like this, you can actually judge to see if a company falls within their absolutely fundamental value, which means that it's going to be a no-brainer when it comes to picking a stock like that. So these are some of the approaches that investors can look at picking, approaching stock picking, and we from Asia Securities will be publishing a report on this. And so yes, that's my overall view on the market.
Excellent. Thank you for that perspective, Naveed. I move on to Shehan Cooray, Director and Head of Research, Acuity Stockbrokers.
Okay, thank you, Nisthar. So some of the other panelists touched on the interest rate hike and the negative real returns on fixed income. So from an asset allocation point of view, looking at allocating from equity to fixed income, it really depends on your inflation expectations going forward, whether fixed income is attractive at these levels. So at the moment it's negative, and we see the country's economic problems are quite serious, so it's not something that can be solved with a one-off rate hike. It also depends a lot on your fiscal framework, and we are yet to see any clarification on that, because you're running almost near double-digit fiscal deficits funded mostly through central bank financing. So the current steps that are being taken in the right direction in terms of the policy rate hike and allowing the auctions to set the risk-free rates, it's a step in the right direction, but that'll need to continue for 3 to 4 years at least. So there's still a lot of room for fiscal and monetary slippage going forward. So we think real interest rates are going to be challenged for quite some time. So in the context of largely negative real interest rates, you would need to be invested in equities. So obviously we understand that in the current volatile scenarios, probably investors should take some chips off the table and have part in cash or in short-term fixed income. And in terms of the market and valuations, so when interest rates go up, it's normal that stocks valuations need to revise down, and we are seeing that not only in Sri Lanka but globally as well. With the bond markets have lost about $7 trillion in value with interest rates going up globally, and stock markets are also re-rating down. So from the beginning of this year, we've been saying that investors should look at fundamentally sound stocks which are at very compelling valuations, which have dollar exposure, which can hedge against inflation and so on. So it's not, all stocks will not give you an inflation hedge or hedge against depreciation and so on. But if you take as a rule of thumb, there are many stocks which are now at 4 times PE. So on a earnings yield basis, that's about 25% earnings yield, which compares fairly favorably even with the current interest rates. And so on a forward earnings basis, if you expect improvements in earnings, they're even cheaper, although earnings will not, in the current economic environment, earnings will not improve for all companies across the board. So we think there are fundamentally sound stocks, and investors should double down on those stocks. If you don't have additional funds to put into the market, you should restructure your portfolio and rotate out of the more speculative and high-valued stocks into the fundamentally sound counters, which have high dollar exposure and compelling valuations. So, yeah.
Okay, thank you, Shehan. Now, we have been listening to 7 views of the fundamental research analysis, and I think we need to look at the technical analysis side of the market as well. So we have Saliya Gamagedara, the manager sales of SC Securities, and also a technical analysis specialist. So Saliya, where does the market is at the moment, and where is it heading? As per your analysis.
Yeah, thank you, Dilusha, and also Nisthar for inviting me. It will be interesting to understand what we should focus. It is nothing serious, it is nothing hard when it comes to technical analysis, as long as we stick to our basics. During the last few, starting from about November onwards, investors and traders unfortunately could not stick to basics. But this is an fantastic opportunity to go back to the basics. Let me share 3 basics which are very important if you all want to win in the market. If you make use of these 3 basics, you will be rewarded. Number 1, understand the overbought and the oversold situations and the psychology behind it. When it comes to overbought situations, obviously when we are investing and trading, what we need to understand is the risk to reward. In an overbought situation, the risk is high, reward is low. And it is a fantastic ground for the traders to make quick short-term returns. As far as the traders are concerned, they had to and they have to even now follow the main rule, which is the stop loss rule. If you don't know how to manage yourself with the stop loss rule, stay away. Fixed income is your kettle of fish. When it comes to investors in an overbought situation, it's very risky. But on the other hand, when you come to the oversold situation, things are much easier to handle. And importantly, the investors have the launching pad. At the same time, a trader who sticks to his trading strategies can also make use of it. But most importantly, the flexibility is with the investor. Why? It's because his strategies do not need the stop loss. His strategy has to be to average down. There are zillions of strategies anybody can follow as far as investors are concerned. They are called accumulation strategies. Learn, speak to whoever it is, and understand what an accumulation strategy is. Thereafter, you have to understand the difference between the sentiments that you have as against divergence the market has. That's where technical analysis is very important. As far as technical analysis is concerned, we know how to understand the divergence as against the sentiment. Because classic example that we saw in December, January is that people's sentiment was ecstatic. They were highly glued in concentrating on the short-term returns and conveniently and unfortunately forgot the risk behind it. At that point, if somebody understood how the divergence, the bearish divergence was forming, they would have got rewarded. Now, in an oversold environment, what is important is to understand how the bullish divergence is taking place. And there are so many counters that we can see. The indications of bullish divergence has happened. Now, why the sentiment is not important? The reason is, when the bearish divergence was taking place, the sentiment was fantastic. It was so bullish. For that sentiment to change to bearish took time, sometimes weeks, sometimes months. Similarly, when the bullish divergence is taking place, the sentiment is still bearish, and it will be bearish moving forward. But if a person who is looking at the oversold situation and understands how to capture the bullish divergence scenario, will be rewarded once again, provided he has the accumulation strategy where he has the liberty of averaging down. Fundamental, all these research experts shared with us the sectors and also the specific counters that we could concentrate on. When the sentiment is bearish, capture the bullish divergence opportunities and follow your accumulation strategies. You will be rewarded. Your reward will be higher than the risk. Thank you.
Thank you, Saliya. So, and also, may I come back to Hasitha? Hasitha, now, as per the initial introduction you have given, further to that, are there any sectors of shares that you would recommend or the investors could look at?
Yes, so I think I touched upon that, but let me reiterate on the same point. So obviously, other than the usual US dollar earning companies that we discussed, another aspect to look at is real estate. In an inflationary environment and a depreciating environment, real estate does provide that sort of protection. Because if you look at building material prices, for example, over the last few months have more than doubled. Right, so your replacement cost on built-up real estate will obviously increase significantly. So if you look at the net asset values of real estate-based companies, your net asset value is going to increase considerably. And at the same time, companies with overseas operations, significant overseas operations, there'll be translation gains on those overseas operations that will come into the balance sheet as well as total comprehensive income on that front. So companies with such exposures will benefit. So you need to look at that. So it's not just on the revenue side where they'll experience gains. There'll be even on the balance sheet in terms of revaluation gains as well as total translation gains on total comprehensive income will all come into play. Then at the same time, there'll be companies that will be immune from the local macroeconomic issues, companies with significant overseas operations. So yes, Sri Lanka is going through a very tough time as we've all discussed, but certain counters will provide investors that protection against the current macroeconomic issues faced in Sri Lanka. So we need to select those counters and move on.
Okay, thank you.
Just a question to the panel here. This was mentioned actually by the new governor that the low interest rate and low taxation really helped companies to come up with record earnings up to last year. With those two going forward, what would be you think you still be that companies will be able to, the companies on the upside will still be sort of reporting good earnings?
Again, we need to, sorry.
Anyone who is in the panel can answer that as well.
So I'll take that question. Now with interest rates going up, you will see highly geared companies, their finance costs would drastically go up. So investors should ideally look at companies' balance sheet and see what are the assets and the liabilities that are there. So in addition to the companies who have locally borrowed, companies who have foreign borrowings are more vulnerable to this condition. So those companies would probably, you will see that their earnings will get, there might be a significant drop. But at the same time, having said that, there are companies who are having large cash reserves, right? One of the colleagues said that the insurance sector is one sector which is going to benefit with these high interest rates. And there are individual companies who are having large cash reserves. I'll again take John Keells as an example. Now, if you track the past 3 quarters of John Keells, you see that their net interest income growing up, right, with interest rates slightly moving up. True that they also have an exposure to foreign borrowings, but they have a huge cash reserve. So that's just an example. So there are companies like that who would benefit. So we can't outright say interest rates going up is bad for everyone. Coming into the corporate tax rates, yes, certain sectors were given the benefit of concessionary tax rates. Yes, they will have to bear that. But certain companies, they might be able to pass on that additional cost to their consumers, right? Especially if it is a product which they are producing, which is in demand. So that's my stance on that.
I've been focusing mostly on the long term for the investors. So this specific question has a element, a short term element as well, something that's going to happen this year. So higher interest rates and obviously higher taxes. Basically, again, I'll be very frank and very blunt here. So if you look at the market situation today, most investors are looking at whether the market will move up or down today. So obviously, there's no reason for the market to move up today. So definitely, we are likely to see a market dip happening. But then, as an investor, what should you do in such a dip situation? So we know that interest rates are moving up, and we know that taxes are also going to move up. So your ideal strategy should be an accumulation strategy. Now, for investors who've been following First Capital and acting upon its strategies would have already basically sold out their portfolios and ready with their cash. So now is the time to start reinvesting that cash, looking at the next 3 to 4 years. And there's no real hurry to do that as well, because already we've only increased our equity allocation from 10% to 25%. So which means we are waiting for things to settle down. So that's what you should do. So at the moment, you can't really find a bottom of the market. If you are going to wait till the bottom, it will be similar for you to wait until the top. Nobody really finds the top of the market and sells 100% of their portfolio at that point of time. Similarly, you won't be able to find the bottom of the market as well. And even if you find the bottom, you won't have quantities to buy. So what should you do? As an investor, you should be gradually accumulating stocks. So next 6 to 8 months, you should be slowly moving into equities and buying stocks mostly into defensive counters. See, the ones that I've mentioned, the dollar income companies, the dividend yielding companies, life insurance companies, all these I factor in as defensive counters. So you should gradually move into these counters and start accumulating into the market. So that is likely to bring you above average returns in the longer term, beyond the inflation levels that are likely to happen. So next few months we will be mostly having positive news, because we've obviously hit rock bottom at the moment. So beyond June we can expect some sort of activity and some sort of positive news to come out, the political uncertainty to settle. So expect these and start acting before they happen. That is the main advice that I can give.
Okay, thank you, Diman. Question to Naveed and maybe Shehan. I know you mentioned that, but given the fact that how bond markets and money markets have behaved since the policy rate announcement, do you think the stock market, equity markets may have sort of adjusted already in terms of mindset? You know, what's your take? Or is it going to be just like any other day, just soon after a policy rate hike? Will the market behave that way, or?
Yeah, so I think to answer your question, I think I mentioned earlier, I think equity markets generally have quite an immediate reaction to interest rate movements. And the sort of interest rate hike we had at the last monetary policy meeting was unprecedented. And we've not given the market to react to that. So I think from an immediate perspective, I think what you can expect this week is for the market to make that adjustment. I think that's something you are going to see.
Any learnings from the fact that any learnings from the bond market, how the bond markets have behaved to the policy rate? I mean, Shehan?
Yeah, I think probably the longer tenor bonds, we've not, I don't think we've seen very heavy trading on those. It's only on the shorter end. But I think, the bond markets will be looking, also will be looking for signs of what's happening in terms of the fiscal roadmap and the IMF bailout and the debt restructuring and all those other factors. So like my colleague said, the equity market, we would expect it to react mostly this week because the policy rate hike happened when the market was closed, and the magnitude of the rate hike was more than what we were expecting.
Okay, so we are very close to the wrap-up, so let me ask from all the panelists one brief question. In very brief terms, considering all these challenges, considering all these economic challenges and everything we are going through, everything we have been discussing about, what's your final take and what's your final message to the investors? Is it a buy, sell, or hold? Let me start with Hasitha.
So as everyone mentioned here, today, tomorrow, there's going to be a negative reaction to the policy rate hike. So I think it's best investors use this opportunity to enter into companies that will give certain preservation and are mispriced at the moment, and use this opportunity to collect fundamental strong value counters that will appreciate faster than the index going forward. That should be a strategy at the moment, given the current sell-off.
Okay, Mahesh?
So the valuations have come down drastically, and it can get cheaper as well, and we might see a certain amount of volatility over the next couple of months. And I would say right now, if someone is entering equity, he should look at more long term, and rather than index picking, you should look at certain sectors that would do in this uncertain environment. So that would be the message.
Thank you. Charitha?
Yeah, I would say to investors, don't get misled by the herd instinct. Don't look at the overall market when you are making a decision of a particular stock. Look at that particular individual stock and make your decision. As others said, there are a lot of fundamentally undervalued shares. So look at your portfolio, look at the future potential of the companies, select the companies which are immune to these current macroeconomic conditions, and select the ones which could benefit out of it.
Dimantha?
Yes. So basically, it's we're looking at some sort of a bloodbath similar to what we've seen previously in the last 2 weeks as well. And so be a prudent investor, and don't follow the herd, and don't get into this panic selling attitude. You should be a bargain hunter collecting within this bloodbath. I mean, there'll be hundreds of stocks trading at 1/3, 1/4 the price it was trading at 2-3 months ago. So try and get into these counters. So whoever has sold out in the market, start gradually buying into the equity, and specifically the defensive counters. Whoever has not sold out, my advice is quickly move in to restructure your portfolio, because defensive counters are the ones that you should be in, and preserving the capital is going to benefit you for the future. And also basically whoever are on credit, obviously while having credit you can't really preserve your capital in this sort of a situation. You should be using credit in a bull market. So in a bear market you shouldn't really be having credit. You should be sort of going into more defensive counters and trading accordingly. So I would like to, as my final comment, recommend investors to start gradually moving into stocks, and use the next 6 to 8 months or 1 year to slowly accumulate. There's no real hurry for investors.
Nusrath?
So yeah, I agree with most of them. What I would say is if you are in cash, then there is no hurry. Yes, watch the market, because there can be a lot of bargains. At the same time, I would also tell investors to do their own homework. I think most of them did burn their fingers because they do not do that. And like many of them said, they follow the herd instinct. So rather do your homework, be informed before you take a decision, speak to your investment advisors and analysts before you do so. And I would also say this is a time to, it's a more accumulation time, and it doesn't have to be done immediately. So take your time and do that. There is a lot of bargain going on. So you have to pick your stocks likewise. That's what I said, do your own homework before you do so.
Naveed?
Yes, I mean, echoing the same sentiments of the previous speakers, I think we are going to see a heightened level of volatility in the market this week and maybe in the coming weeks also before we start to see some stability. If investors are already invested in, fundamentally strong counters that have, strong balance sheets that would likely be resilient, then, I mean, it's always advisable to, hold through this period. If you are heavily leveraged, to an extent, it will make sense for you to deleverage a bit, especially given that the rates are higher, but obviously not to follow a herd mentality if you are invested in strong counters, to keep holding on to that. And lastly, with the sort of adjustment you're going to see in the market this week, the market is going to be ripe for bottom picking. You're going to see some of the stocks reaching that long-term support trend line, reaching that fundamental value, which will provide really good entry points for the medium to long term. Not just for capital gains, but also for very strong dividend yields in the future. So I would say investors should pay close attention, do their own research, and I think it's a really good opportunity to enter the equity markets at this point.
And Shehan?
Yeah, so broadly echoing the same sentiments, I think we are probably likely to see a lot of selling pressure from investors who are on margin and so on. So it's a good opportunity for investors who have a more long-term outlook and holding power to bargain hunt and pick up stocks at very cheap valuations. And definitely they will pick up over time. And where you make outsized gains in equities when you see bloodbaths like this, and you pick up these stocks at very good values and hold them for a while. So this is an opportunity for that. Yeah.
Last but not least, Saliya.
Blood is on the street. Seize the opportunities before it dries.
Thank you very much. And I would like to thank the lady and the gentleman here to spending your time in the morning, and also at the most crucial time that the investors would require a direction. Thank you very much for joining with us. And also, the challenges are inevitable, risks are inevitable. Whoever is finding the opportunity, identifying the opportunity, and acting upon it would be the real winners. Nisthar, anything to add?
On behalf of Daily FT, thank you very much for everyone for taking a risk actually in pre-market, coming and giving your own perspective. So we heard about bloodbath, so much negativity, but also there's also a ray of hope in terms of undervalued stocks and a lot of, going forward, a lot of positive news expected. I think as promoters of capital market, we would like to see bloodbath as well, and hopefully green close by afternoon if possible. I'm sure the investors are going to make the decisions eventually, and let's see how they will behave today. And I'm sure all our panelists gave valuable insights, both for mature investors as well as retail investors, and for those who are yet to make entry to equities. So this is the time, as many of the people, experts said. But let's see how the market behaves today. And I know we are in for some exciting days and weeks ahead. So thank you very much to everyone, as well as thank you for Dilusha as well.
Thank you very much, ladies and gentlemen, for being with Market Pulse. Thank you very much.